Good evening, students. I hope all of you are keeping in good health and in the middle of a good hard work, planned preparations for the upcoming examinations. Welcome back. Nice to be, back with all you guys for another important topic as we discussed a couple of weeks ago. So we are after the cost of capital understanding and some other chapters in between, a very significant topic which relates to your investment decisions. So I'm pretty much sure that all of you are super excited for a couple of sessions on this one, and this remains a very, very important topic for the examination. And I can already see a lot of excitement. Good evening, everyone. Again, I can see Pooja, Pratiksha, Narayan, Sandeep, Hina, Tanu, all the messages. So good, guys. Really looking forward for a good, exciting couple of sessions. I'm sure you guys are pretty much looking forward for the same. So as we generally do, we start the session with a question here, right? So my question here is to you guys. Can you tell me why an investment decision, an important decision for any organization? Just mention one or two words, that's okay. Why an investment decision is an important decision for any organization. Let's see, what do you guys think? Okay, so let's see who is the first one to respond on this. Why is investment decision an important decision? Now, I am sure some of you might say this is one of the three decisions, right? So we talk about financing. We already talk about financing and cost of capital, though. But what we are discussing now is investment decision. Just waiting for some responses on the Q&A box. Okay, I can see that now the response is coming in. Charu says it involves risk and return. Very good. Then we talk about limited funds by Sakti. And then Rohan is saying that to check whether the investment will be profitable or not. Yeah, so that's very logical, right? So I would like to combine all of your answers actually. Pooja saying about for growing and for profit making. Okay, so Pooja, let's move forward from a profit making to a wealth maximization. Optimum utilization of funds, that's what Sandeep said. So I think probably if I kind of combined all the answers given by you guys are absolutely correct in your respective replies. But at a macro level, if we understand, let's say if we are talking about that, okay, I'm seeing some more responses, using the resources economically, where to invest, it decides the future earnings, Khushi said, Brinda said, why to invest, where to invest. So I think all these answers are actually boiling down to very important aspects here. I think you are worried about where to invest resources. My question is why. You all said optimum utilization of funds. You said, my question is why. The answer to this why is the scarcity. We know that no organization, no one has abundance of wealth. We generally and these investment projects require huge funds, huge investment, and you generally have limited capital, and that is why it is important that we target to have an optimum utilization of funds in order to maximize not the profit but the wealth maximization, right, guys? Now, as we discussed earlier also, in terms of cost of capital, that because while you raised funds, each and every rupee invested is, carries with itself some cost, some burden, right? It becomes very important that you want to utilize that in a prudent manner here. Very, very important here. And that means what the stakeholders are expecting, you need to abide by that. So that means why capital budgeting becomes important. As I said, the resources are scarce. I think another important aspect is that it's not a short-term decision. As said by Arumal here, Arumal says It's a long-term nature. It's very important. It's a long-term decision. It's not a short-term decision. I also believe that there is no U-turn generally. So if you invest 20 lakhs, 50 lakhs, 5 crores, the decisions generally are irreversible, because see, if you want to set up something, set up a factory, and you say that, okay, hey, it's not going my way, right? So 6 months down the line, you said, okay, let's just kind of wrap this up. Let's make a U-turn. I'm not saying that U-turn is impossible here, but the idea is that you might end up incurring huge losses. Let's say you invested 2 crores in setting up something, but something is not working. You took an incorrect decision. After a year, you end up winding up everything. You think you will get 2 crores back? Absolutely not. Forget about the return though. And also, very much important is that we need to understand how to evaluate the various alternative investment avenues, how to evaluate the profitability. What is the difference between a net income and a cash flow? All these aspects are important, and that's why our capital budgeting becomes very, very important here. Now, okay, I think everyone is absolutely understanding that yes, okay, this is important, and I think I'm glad to see all the responses till now. Now, also important is that we need to understand that means this is a process, right? Capital budgeting in itself is a process. So what are the steps involved in the capital budgeting process? So the first step here is we need to understand, okay, hey, we want to expand, we want to set up something. What are the alternatives available? So we are talking about, as a first step, identification of investment projects. Of course, we will map it to the organization mission, of course. We then, once we know these are the projects, we then evaluate the incremental cash flows associated with these projects, guys. We don't consider the net income. We consider the incremental cash flows, for each investment proposal over there. And then we, kind of evaluate those proposals. We select the one that maximizes the return to the investors. And there are different techniques, mind you. We know that, okay, probably a time value of money is very important, because generally most of the investment, decisions or investment proposals require an initial lump sum amount to be invested in a huge quantum, and it requires, or rather gets, the returns in the coming years. So you need to kind of have an apple to apple comparison, right? So that is very important, that, okay, we need to understand what is a time value of money then. Then once we select particular project or combination of projects, also important that we monitor. How do we monitor? We are basically reviewing, we are controlling various projects selected. So these are various steps, guys, for capital budgeting as a process. We are talking about planning. We are talking about evaluation. We are talking about evaluation with respect to their returns, risk attached. Some of you responded to risk and return. That was amazing. And then based on our evaluation, we are doing some selection and followed by an implementation of stage, and you monitor the success and review. I'm pretty much sure that the capital budgeting process as a whole is pretty comfortable to each and everyone here. So let's talk about, there are a couple of types of capital budgeting decisions. Having said that okay, my capital is scarce. I have a scarce capital, but there are probabilities where I could be willing in putting up my money in more than one proposals. So we need to understand what kind of decisions we have to take. So these decisions are based on two categories. One is based on the decision itself, decision situation. Another one could be basis of firm existence. Now, what do you mean by firm's existence? Like every business, every process has a cycle here. Let's talk about today. You have set up a factory by investing, let's say, 50 lakhs in a plant and machinery. Is that forever, guys? Is it forever? I am sure that that's not forever, right? There will be a time coming after 5 years, 10 years, 15 years. You might have to take a call. Hey, either the technology has put you backwards, or there is your existing machinery, even if it is relevant today, may need a replacement. So the decisions like based on the firm's existence, a particular economic cycle could relate to a replacement decision or a modernization decision. Then, okay, you set up something today, 5 years, 7 years, you flourish like you become another Reliance tomorrow. Now, the point is there would be a certain stage where you may decide to expand. Why not? There could be a situation where you want to diversify in terms of product or service lines. There could be some times where you want to expand internationally also. All these decisions could be signifying the firm's existence. The parameters, though, whether it is a decision based on a decision situation or a firm existence, are common. We will be considering cash flows. We will be considering the different techniques, how to evaluate these proposals. Right now, I'm just kind of giving you a brief overview of the same, nothing else. Right. So, what are the decisions based on the decision situation? Let's say you're being proposed two opportunities. Now, what does that mean? Is like you might have to choose only one. Why could be that? Probably you might have had a limited capital, right? You may not have abundance of capital. So if you accept one project, you automatically reject the other project. So that is again also a situation where we are looking at probably a mutually exclusive decisions. Where you accept one proposal, that means you're not able to accept any other. Then there could be a proposals with respect to accept or reject. Where you want to just compare one proposal. You're not having multiple proposals, either take it or leave it. Or probably you're talking about some proposals having some kind of a decision tree or a contingency where you may think of, okay, if you go for a plan A, you may go for a plan B as well. There could be a one decision dependent on another. So again, as I said, whether it is an expansion, whether it is a routine decision, you would need capital budgeting techniques to understand it. So let's talk about the capital budgeting techniques, and the first and foremost discussion into that is your cash flows. Second question for you guys for the evening. Second question, guys, why do we think that, we need cash flows to evaluate the investments and not the net income? Guys, probably we might find net income from income statement. That's it. We have an income statement or probably a forecasted income statement, I would say, where we have a projected revenues, projected expenses. We come across a net income, forecasted net income. Why we focus on cash flows ahead of net income? Can anyone tell me here? Let's see what are your responses. Why we are focusing on cash flows rather than a net income? Okay, let's see what other responses. Vivek says, sir, liquidity matters. Good. Liquidity matters probably. That means, Vivek, you are saying that, okay, you are concerned about that. Hey, I have put in some money. I want to ensure that what is the span of time where I will be getting that back, because of liquidity matters. Okay, what about others, guys? Just got one response till now. Okay, now I can see more responses. Okay, we're looking at cash flow is the cash currently available with us, and net income is based on the historical data. Rohan, I said that even I can have a projected or a forecasted financial statement. Net income we can compute from there also. But the point is that what I'm looking forward is something more. Someone says quick to invest according to market conditions. Sakti said quick to invest according to market conditions. But why cash flows? Why not net income? Guys, do we agree that? Okay, let me see some more responses. Pooja said cash flow for liquidity. So everyone is like liquidity. Okay, guys, do you agree with me that when we calculate net income, it requires a lot of provisions, accruals, some estimates, which probably you may not involve an immediate cash outflow, may be subject to some kind of a biasness. So when we're looking at cash flows, the idea is we are looking at more of a relevant cash flows. Something which changes. So we will never focus on the net income for the purposes of cash or capital budgeting decisions. We'll be focusing on the cash flows. I'm just seeing a couple of more responses. Sonu says cash flow does not consider depreciation or other non-cash. Exactly, Sonu. That's what I said. And then Charu said that cash flow also indicates maximization of wealth. Indirectly, yes, Charu. But yeah, I think the more important point is while we are computing net income, there are a lot of non-cash items. Accruals, provisions, depreciations. So we need to understand, that we are basically taking decisions based on the relevant cash flows. Okay. Abhijit says accuracy. Yeah, we will try to definitely achieve that. And then non-cash expenses, opportunity costs are other responses from Saurabh and Vivek. Great. So guys, basically what we are considering now for all the capital budgeting decisions, we will be considering only cash flows. And not only that, we are looking at incremental cash flows because these are the cash flows which are relevant cash flows. Mind you, what do you mean by incremental cash flows? Let's say I'm already having a monthly revenue of 10 lakhs. And if I want to upgrade my machinery to a latest technology, my revenue becomes monthly of 16 lakhs. So that means my incremental cash flow will be 16 minus 10, 6 lakhs. Because of that capital budgeting decision, my incremental revenue is only 6 lakhs. 10 lakhs I was anyways earning, guys. Okay. Also, an important point is that the timings of cash flow doesn't match with the accounting profits. We know that because investments require immediate outflow. Accounting profit requires your accruals. It may not be as in the same year. So what are the factors we need to consider to arrive at the project cash flows? One is depreciation. Now, depreciation is a non-cash item, but it is very important to understand that this gives us the tax shield. What is tax shield? What is tax shield here? That means it reduces the tax liability. It acts like a tax deductible expense. So we know that okay, depreciation is allowable expense. My tax liability will go down. So depreciation, even is a non-cash, it provides us tax shield. So for depreciation, we will be ignoring it as a non-cash expense, but we will be considering the tax saving on the same. We will be considering the tax savings on the same, guys. Now, there is a very interesting point which kind of correlates with respect to income tax act provisions, which follows a block of assets concept. I'm sure most of you know that, right? So what happens is, when you sell an asset, we consider gain or loss only if that was the last asset. Otherwise, you know what is block of asset concept? That if there are other assets in the block, you don't actually recognize gain or loss till the point there is a last asset over there. So that anyways we'll consider if any question is actually requiring us to think about the same. Now, then next one is opportunity cost. Any foregone cost or a benefit to be taken into account. So let us say guys, okay, let me ask you guys an example. Any example of opportunity cost, guys? Any example of opportunity cost here? Let's see if you guys can participate in this. Any example of opportunity cost, guys? Yeah, Vivek, Charu, Vandana, your responses with respect to the tax benefits were absolutely correct. But my question is, give me an example of opportunity cost. Okay, opportunity cost. Okay, someone is asking me what is a block of, Sandeep is asking me what is a block of asset. Block of asset is like, Sandeep, tax laws generally, require you to charge depreciation on the specific classes of assets. Let's say machinery is one block, furniture is another block. Computer equipment could be one block. Okay. But my question was, what is an example of an opportunity cost? I hope you understand the benefit, the definition of opportunity cost, guys. Is the cost of the next best alternative. Okay. Interest on investment is what said Narayana. Khushi said cost of shifting from production of X to production of Y. Yes, Khushi, we can say that, and that is why we are saying incremental. But I will give you a very interesting example. So I'm actually liking an example given by Abhijit. Abhijit is absolutely on the spot. He says like practicing instead of job. So Abhijit says my package, what I would have get in the job is opportunity cost if I go to practice. Interesting, Abhijit. And then Charu also gave another example. To get one job of 90,000, the 50,000, then the opportunity cost is 50,000. Great examples, guys. Guys, but in terms of capital budgeting, I think you guys are. I think you guys are very opportunistic and very optimistic, and that's very good actually. Positivity. That's the game. Rule of the game. Everyone is replying me on the CA exam, CA fees. If you teach CA on ICAI branch, then you forgive your teaching privately. Wow. Yeah. Pooja is kind of hitting directly on me here. Okay. Pooja, yeah, I don't take private, classes anyways. Then we are saying, I'm actually looking for an example which Sakti gave. Sakti, very good example. I will read your example towards the end though. Then they're saying that, okay, practical training fees, and everyone is giving me CA examples. Okay. Rohan said, if a person is working at 35,000 per month and he can also work for 30,000, so 30,000 is opportunity cost. Guys, but okay, let's talk about. Sakti said about renting. Guys, let's say I have a vacant building in this Kundli in near Haryana, and I'm getting a rent of 3 lakh rupees. I don't have, by the way, I'm just taking an example. I'm getting a rent of 3 lakh rupees. And let's say some of you, after you become chartered accountant, come to me with a business proposal that, hey, sir, we can enter into a partnership. Let's start this business. Let's set up this factory. Now, if I want to set up a factory, I will also apply this capital budgeting techniques. But for me, the opportunity cost will be that rent of 3 lakhs per month. Guys, make sense? I hope everyone with me here. Example by Preksha. Preksha said, suppose Mr. A decides to invest in plan B, which is giving a return of $4, and the plan A is giving a return in 3, then yeah, that's fine. Preksha, good example. So guys, I hope everyone agreed in terms of capital budgeting. A good example could be a rent of the premises, because you are already earning rent, and if you want to go for another project, that will be your opportunity cost. Okay. Question from a student asking about the tax shield benefit treatment. We will discuss the tax shield on depreciation, guys. Don't worry. In 5 minutes time. Okay, but I hope opportunity cost is clear. So we will be taking the opportunity cost in the evaluation. Then the sunk cost. Now, guys, sunk cost is the cost, historical cost, which is already incurred. Should the capital budgeting decision take into account sunk cost? I don't think so. Whether you pursue a project or not, sunk cost is sunk cost. So let's say my existing machinery costed me 5 lakhs 5 years ago. Is that relevant for me? No. So sunk cost absolutely are sunk. Don't consider them, please. Working capital. Now, working capital could be interesting. Now, let me talk about this. Working capital requirement in a particular project. Let's try to understand this. Okay. So guys, in terms of working capital, there could be various possibilities. Let's say, I'm just trying to draw a simple graph. Let's say your existing working capital is around 100,000. And you probably are planning to start a project which requires you to increase your working capital. Let's say your project is starting from this point and suddenly you might have to increase your working capital to 3 lakhs. So either you might go like this, and let's say my project is ending here. Once the project ends, you don't need that working capital anymore, and you say that, okay, let me withdraw that working capital. That could be one possibility. Another possibility is, let's say, my working capital initially in the project requires me to increase from 1 lakh to 2 lakhs. It will then remain same. After a couple of years, it requires another 50,000. After a couple of years, it requires another 50,000. And then probably at the end of the project, I don't need additional working capital. Guys, does this make sense? So I'm thinking of possibilities. Possibility one. One possibility, I infuse 2 lakhs immediately. That means it immediately my working capital will result as an outflow. And at the end of the project, I will say that, hey, now I don't need that additional working capital. I can release that additional working capital. So releasing the working capital will be actually an inflow for me towards the end of the project. Yes, does that make sense? I hope everyone with me on this. And also, the second possibility could be working capital requirements can be increased gradually. You might want some working capital immediately, some working capital after 2 years as you expand. Very logical. I hope working capital point is clear to everyone. There could also be a position here, guys. Let's say that I am thinking of automation for 3 years. So what's happening is my working capital was 100,000. Because of the automation, I actually now don't need a working capital of 100,000. I need only 20,000. So initially there is an inflow of 80,000 here. But after 3 years, when the automation is over, I don't want to continue automation after 3 years. It goes back to 100,000. So then it could be another outflow back. It restores. So we call it as a restoration of working capital. I'm basically sharing with you guys 2 or 3 different scenarios which could be there with respect to the working capital, guys. I hope everyone is with me. Pooja just acknowledged, thanks. Guys, I hope you understood all the 3 possible scenarios for working capital. Depending on the question, we will take a call, right? Whether you need an initial. So if you ask me, honestly, most of the questions make you fall into the first category. Most of the questions. But yeah, there could be a second or third scenario as well. I hope this is clear to all of you. Okay, so let's go back to our presentation here. So what we are looking at this side is working capital to be considered initially at the end. So we were talking about case 1 and case 2 or case 3. Anyways, initially and at the end. But there could also be an incremental during the tenure. So the example number 2. And also, there could be either an addition or reduction in working capital initially. Accordingly, a vice versa situation at the end. I'm just seeing that, okay, there are no questions asked. That means probably you guys are comfortable on the working capital at least. Someone said third again. Pooja said third again. Pooja, third May, what we did was, because of automation, there may not be a lot of workers required. Automation. So your working capital, let's say, was 1 lakh. but because of the automation project, you need only 20,000 now. You can release some of the workers. So 80,000 come ho jayega, it will be reduced from 100,000 to a 20,000. And then after 3 years, if you stop that automation, you need more workers back to the normal, position. Then you kind of go for an additional working capital again. Okay, guys. So another important aspect here we need to understand about allocated overheads. Now, allocated overheads is where let's say a head office incurs some expenses and it is allocating to different branches. Now, generally allocated overheads should not matter, but if there are any incremental, then take it. Incremental is if because of the project, if there is a change, because of the project, if overheads increase, then just consider the incrementalize. Also, another important point to be considered that any project could either result in increase in revenue or saving in cost. Do you agree with me? If you are going for a project, you are either looking for increase of revenue or you are looking for reduction of cost. Whatever it is, inflows can be by increase of sales, inflows can be by reduction of cost, inflows can be in the forms of increase in cash profits. Whatever it is should be net of tax. Because if you are saving, your profits are going high, your tax will be paid. Just like depreciation gave you tax saving, operational savings or cost reductions could result in a tax outflow. So you will say net of tax, guys, net of tax. Also, additional investment at any stage to be taken into account. That's okay. Let's say we are saying that, okay, a project requires 20 lakhs initially and 10 lakhs after 3 years. So you will accordingly consider the outflow in the initial period and after 3 years. I will talk about depreciation tax shield, guys, don't worry. Okay, last point is a very, very important point. Guys, we need to understand that there is something called time value of money. Let's say I tell you guys today, hey, I am giving you a package of 15 lakhs per annum today. And another option is I'm giving you a package of 15,50,000 a couple of years later. Guys, which option will you select? Will you select a 15 lakhs job offer today or a 15,50,000 2 years later? Let's see. I'm sure everyone might say that, okay, 15 lakhs today is much better. That means you consider that, okay, the value of money will deteriorate, right? Everyone is like first option. Abhijit says any day. Abhijit says any day. I would go for a first option any day. Just give me the job offer. That's why we are here, right? So that means everyone is with me here. So you understand that, okay, there is a time value of money. Now, for that time value, okay, Abhijit says, although both are equal, I will go with the first option. That's okay, because you might have discounted it by the inflation rate or whatever. But the idea is that we know that there is a time value of money. If we want to consider a project in a nutshell, let's talk about this. Any investment decision, let's say we talk about 5 years. Now, we might have outflow here and we might have inflows coming in across the years. But what is important is that you guys are standing here. You have to take a decision whether to accept a project or not. Now, to compare this outflow to all these inflows, it's important that we take these inflows as a present value by discounting them. So we discount them by various discounting factors. We multiply each of these inflows accordingly. We multiply all of them. Now, my point is here for discounting, the rate of return is generally the WACC. I told you in the cost of capital chapter also that we will be calling it as a hurdle rate or a WACC. We'll be using it in investment decision. Now, because, okay, you guys agree that we are discounting it because something is called as a financing cost. Guys, if I'm already discounting my cash flows with the financing cost, should I take interest as a reduction, as an outflow, guys? Should I take interest as outflow? What's your thought? I'm already discounting my cash flows to today's date. Sandeep, I think I saw your answer also. I think you said 1.5 crores today. I think zeros are good as long as they're after the number, right? Amazing. Why not? We can get 1.45 crores definitely someday, right? But anyways, guys, everyone with me on this, that if I'm discounting these cash flows, probably we need to understand that, hey, we should not be taking an interest as an outflow. It's a double counting then. It's a double counting. To avoid that kind of a scenario, it's important that any financing cost, look at the last point, any financing cost and any dividend needs to be excluded as the same is reflected in discounting factor. So if you guys are by any chance in a question given, a profit after tax, please add back the interest. Please add back the interest net of tax to the profit after tax. Or you just take earning before interest and tax and multiply this by 1 minus t, or multiply, not multiply this 1 minus t, reduce the tax otherwise. So whatever you want to do, you don't consider the interest aspect, guys. Don't consider the interest aspect because that is anyways considered while discounting. I hope everyone with me on this. Sandeep, that's absolutely okay. That's your package, right? You deserve it. Okay, so let us talk about now stages of the cash flows. Let's talk about very important slide. On my blackboard, if you saw, there were different stages of the cash flows. Initially, there was an outflow, right? So we are considering the stages of cash flow in 3 phases. One is the initial phase, one is the project life interim phase, and then one is the last year, the terminal year of the project. So what will be my initial cash flows? Let's understand. One will be the initial investment phase. If you want to set up something, cost of the new asset installation, investment in the working capital, it could be savings also. Remember my example of automation. It could be either inflow or outflow. This could be either inflow or outflow. Most of the questions give you an initial outflow though. Then sale proceeds of existing or old asset, guys. Very important point. The sale proceeds of the old asset. And if there is that asset was the last asset in the block of asset, there could be also any gain or loss that will impact any tax implication. So sale proceeds of the old asset, net of any tax saving or liability. So this is interim cash flows or initial cash flows. Now we move on to the interim cash flows. So the 3: initial investment, working capital, or sale of the existing asset, initial cash flows. What is interim then? Interim is during the project life. Now, during the project life, I will have profit after tax plus non-cash expenses. Of course, interest to be excluded. As I mentioned earlier, if it is a replacement, look at this, very important, guys. If this is a replacement project, you consider incremental revenue or saving in expense. Because if there is a new project, you did not have any earnings already. So you say net income, net cash profits in short. Okay. But if it is a replacement project, that is there is already something in the operations, let's say you're already earning something, you're already spending some cost, there is some saving of cost, or there is an incremental revenue, we're saying that, okay, hey, net of tax. And then we are saying that, okay, hey, any additional working capital also. The second example I gave you, during the project also, sometimes you need additional working capital. And then we are talking about as a last point, which says that, okay, the third aspect with respect to the terminal year cash flows. So it is interim cash flow of the last year, guys. So whatever will be the profit after tax, cash profits after tax, or saving in cost, or incremental revenue, all these will also be in the last year, right? So this is the point. The last year cash flow, then salvage value of the asset, you might be selling it. Then whatever working capital you did in the beginning, you are releasing that in the last year, or you are restoring that in the last year, depending on if the working capital was an inflow initially, it will be an outflow now. If it was an outflow initially, let's say initially it is an outflow, then you will have an inflow at the end of the project. So I hope everyone clear, guys, with the stages of cash flow, initial, interim, and terminal year. I hope everyone clear on this. Okay, so how we consider this cash inflow after tax? So if you see this, we generally have a normal, total sales, variable cost, which gives us a contribution, less the fixed cash cost here. So we're looking at a fixed cash cost. If the depreciation is reduced, look at that. Depreciation is added back later on. We are adding the depreciation back later on. So amongst these two, the depreciation is added back towards the end. Because what we are looking at is that, okay, hey, we reduce the depreciation because it would give us a tax saving, and then we added that depreciation back. So what we are saying here is that our focus is cash inflow after tax. That's what we will be considering, guys. Now, one of the method for dealing depreciation is this on your screen anyways, that you reduce the depreciation and then you add back the depreciation onto the earnings after tax. I would say depreciation and any other non-cash expenses. That will be added back. Now, two methods for understanding the depreciation tax shield. The first method is something which you just saw on the last slide. The first method is something we just saw on the last slide. That means, I'm just taking a same example here. Earning before tax and depreciation, you are looking at a 50,000 minus the depreciation of a 20,000 here. And then earnings before tax, and you get a profit after tax of 21, and this 20,000 is added back to get a 41. That is a straightforward method which we just saw on this last slide, and the method one for you. But there is another method in case some of you feel comfortable that, hey, we want to consider a depreciation tax saving separately. I have a question from Vidyadhar. Vidyadhar says, can initial investment be inflow? Again, the idea is that mostly when you're saying initial investment, it results in an outflow, right? Subsequently, it could be a possibility in terms of a working capital, as in like where I say that, okay, I took an example with the other about the automation project. If you're automating, there has to be some outflow, whether you're talking about a software or something, but that automation may help you to release some working capital. So that component could be an inflow initially. But more or less, the chunk of it, the major corpus, that is the initial project outflow or investment will be an outflow. I hope that makes sense. Okay, the second method to understand the tax shield is, look at this. We took this 50,000. We do not deduct the depreciation here. We say that, okay, tax is 30% is 15,000. That means my cash profit is 35. And then I add the depreciation tax shield, 20,000 ki depreciation, on which 30% tax is 6,000, and you get a 41. Because of depreciation here, what we are seeing here is that my tax of 15,000 is actually reduced to 9,000. And that means 15 minus 9, that is 6,000, is my tax shield. That's a tax saving because of the depreciation. Depreciation is a tax deductible expense. I hope both the methods are clear to everyone. Saurabh, because WACC represents all the sources of finance. The expected return of the equity, the expected or the return or the cost of the debt, because your funding is coming from equity or debt, right? And that's why WACC. Saurabh asked me a question, why WACC has a discounting rate? Saurabh, does that make sense? Because your funding is coming from them, right? Financing decisions. It could be equity or debt. So we are looking at a WACC here. Okay, so guys, let's move on to capital budgeting techniques quickly here. Now, there are two types of capital budgeting techniques. As I said that, okay, hey, you have a limited capital, you need to take some decisions, crisp decisions. So you need to understand that, okay, that we need to select the most profitable investment here. So because if you are talking about a bad decision here, that could be impacting you like anything. Now, capital budgeting techniques could be basically categorized into two aspects. One is non-discounting techniques. We also call it as a traditional or old-fashioned techniques. And then we are looking at a time-adjusted or a discounted ones. The more relevant, of course, I think each and everyone agree with me that more relevant techniques are the time-adjusted or discounted techniques, because these are the techniques we are anyways looking at from a perspective of a time value of money. Okay, so Charu saying initial investment can also create cash flow. For example, if you receive grant from government, is it right? So generally, Charu, what happens is grant reduces the initial outflow. Let's say that you have a project of 50 lakhs and government is giving you a grant of 10 lakhs. So 50 minus 10, 40. So that could reduce your initial outflow. So you are correct in that example. I hope that's what you meant, right? Subsidies or grants received by the government. Good example, by the way. Okay, so majorly we will be focusing on discounted cash flows, by the way, because in terms of the discounted cash flows, we are considering the time value of money. So there are various methods for discounted ones: net present value, profitability index, IRR, modified IRR, and discounted payback. Whereas we are focusing only on two methods in terms of traditional methods, non-discounting, that's payback and accounting rate of return. So we'll discuss these one by one now. First of all, let's keep aside our non-discounting techniques. So let me do one thing. When I'm looking at a payback period, let's also try to understand, I will also talk about discounted payback parallelly after a little while. But first method is a payback method. Now payback, the name suggests, when will be your capital investment will be paid back? When will you get your investment back? So this is basically in a nutshell, we are looking at, okay, it's a length of time required for the cumulative total cash flows from investment to equal to the total initial cash outlays. So whatever you are getting or spending initially, in how many years you will probably get that back. That's the focus. Guys, any idea in what areas, in what cases you would be worried about payback or a discounted payback? The difference between a payback method and a discounted payback is only that in a discounted payback, you take the present value cash flows. In a payback, we don't consider the present value cash flows. Can anyone tell me why we will be considered, when we will be curious and worried about payback period, guys? Any thoughts? What will be the scenario where I will be considering or giving a payback period a good amount of consideration as one of my decision matrices? Let's see your responses, guys. Why would a business be considering a payback period an important factor? To know when we recover cost, Abhijit says that. Jamil is saying when we are investing, okay. Yeah, that's okay. When we are investing, that's okay. But Jamil, my question was why? Why we are giving this an importance, by the way? Absolutely perfect, Charu. Charu giving me an amazing answer. Charu says, when there is a risk of insolvency, probably I would like to refine your answer, Charu, that when there is a risk involved, forget about the insolvency though, when a project is a little bit more risky, I want to be considering that, hey, I want to be sure that when I'm getting my capital back, rest aside. So probably I'm looking at a risk involved. And that actually is a drawback of this method also, that I'm not worried about how much profit this project will give after my capital is returned, right? I'm just concerned about payback period, whether this project will give my capital in 4 years, 7 years, when. But what is happening in that project after those years, when my capital is back to with me, I'm not considered, I'm not bothered. So other answers given by Saurabh. Saurabh says when the investment is huge, absolutely Saurabh. So again, you are also indicating towards the risk. And Rohan has a very interesting perspective. Rohan says if the firm has scarcity and don't want to block the funds for longer time, yeah, that's an independent business choice. They don't want to spend invest and get their funds blocked in longer projects. That's okay. So good answers, guys. Absolutely good answers. Pooja and Sandeep also indicating towards the risk. Absolutely perfect, guys. So so for this calculating the payback, you just need two inputs. What is my initial capital investment and what is my annual after-tax cash flows? Because you will just add your annual after-tax cash flows and compare with the initial investment. That's it. Now there is another thing called a payback reciprocal, which is, as the name suggests, is a reciprocal of the payback, which gives us a close approximation of the IRR. Now, we will be talking about that later though. When we'll be talking about the discounted methods, I will explain you what is an IRR. But right now we are just saying that, okay, the reciprocal of payback is giving you a fair idea about, what will be an approximate IRR of the project. Now, I would like to understand how do we calculate the payback period. Now, generally, if I'm looking for two different methods, let's talk about this. So payback period, let's take an example. My initial investment is 100,000. And let's say that this is my case A. And these are my years. 1, 2, 3, 4, 5, and so on. And I'm writing my inflows here. This is my initial outflow. So I mentioned 25,000 every year. So this 25,000 goes on, let's say, for another like 10, 12 years. So I'm getting these returns. Vivek, awesome response. Vivek said security of the money, because you might have more investments coming up after 5 years, 7 years. Okay, in this case, the example I just took, 25,000. So what is my payback period, guys, in the case A? What is the payback period in the case A? What are the thoughts, guys? I think everyone with me, 4 years. I think easy answer. Abhijit said 4 years. I think everyone will be 4 years. Now there are two ways to calculate it. Either I just simply do 100,000. So this is a case of a uniform cash flows and I divide it by 25,000. So it will take 4 years. Or I probably add them up cumulatively. That also will give me the same answer. But why to spend time? That is required in another scenario. Let's say this is the case B. Okay, let me give you another example here. Case B. What will be the payback period here? I don't have a uniform cash flows. So dividing my initial investment by a particular cash flow will not work in the case B. So what I will do is I will create a cumulative cash flows here. And we'll see what is the cumulative one. 30,000, 60,000, 80, 95, 105, and so on. That's my cumulative cash flows. If you see logically, my 100,000 or my 1 lakh is being recovered somewhere in the 5th year, guys. Here. So that means my 95,000 is recovered till the 4th year, guys. 4. After 4 years, how much I needed to recover, guys? 5,000 more, right? Everyone with me? After 4 years, I needed 5 more thousand. So 4 plus 5,000 upon how much was the total cash flows in that year? 10,000, guys. So 4 plus 5,000 upon 10,000. I'm getting a 4.5 years. I hope everyone with me on this. Question from Lokesh, sir, present value concept will be used or not? Lokesh, I will just talk about the present value concept, then that method is called a discounted payback and not payback method. I will talk about the present value concept in a while. I hope everyone with me on the 4.5 years. Okay, now let us talk about another way to look at this. The same example, I can say that, okay, hey, what was my initial investment? 100,000. Guys, I'm just showing you one more way. I leave it up to you, whichever method you want to follow. I have received a 30,000. So that leaves me a 70. Sorry. Yeah, that's okay. Then I am looking at another 30,000. That gives me 40,000 to be recovered. I receive another 20. I am left with 20,000 to be recovered. 15. Now they are left with 5,000. And now I'm getting a positive 5. Guys, in the orange and red, the only difference is I started with my outflow cumulatively. The method is same. I'm just giving you two different options. Here also the answer will be same because my 0 falls between -5 and +5. The answer is same. 4 plus 5,000 upon 10,000. Whichever method you are comfortable with, I just explained you both the different ways. So even for cumulative, you have multiple options how you want to do it. Everyone with me on this, guys? I can see confirmation from Rohan, Vivek, Lokesh, Abhijit, everyone, Pooja, everyone. I'm sure everyone is okay with. So I'm leaving it up to you whether you want to follow an outflow or a negative one or you want to start with an orange one. So I'll leave it up to you. Now, since I'm on payback method, probably I can also talk about a couple of things here. I think if we understand that, okay, what is my positive of this payback period? What are the value additions of the payback period, guys? Plus, what are the plus points? We say it's very simple. I'm not even writing these things. The basic point is it gives you a measure of return of capital or return of your investment. But the point is there are some negatives as well. It ignores the time value of money. Second, it ignores what about the profitability of the project, guys? Now, whether I am looking at uniform cash flows or I'm not looking at uniform cash flows, did we talk about what happened after 4.5 years, guys? Did anyone ask me what is happening after 4.5 years? Someone is asking me 10,000 from there. Charu, 10,000 is in the fifth year, na? Column B. 10,000. 10,000 is the fifth year cash inflow. Because remaining amount to be recovered upon the cash flow for that year. I hope making sense, everyone. Charu, I hope it is clear. Okay, now let's while we are on this example, let's also talk about a discounted payback method. Some of you are saying that, okay, sir, we are not considering time value of money. That's okay. But I'm sure everyone is with me that the problem with the payback, whether payback or discounted payback, we are saying that, okay, this method is not considering the profitability of the project. My question is, if I want to talk about the discounted payback, let's say I want to mention this B, cash flows, in a discounted method. Let's say I use a 10% WACC or 10% discounting rate. So discounting factor of 10%. My question to you guys is, in the same example, discounted payback period will be longer than a payback or shorter than payback? I need an answer from you guys with reasoning. Will the same example give a longer discounted payback or a shorter payback period in terms of years? Will the number of years will be more or less now if I'm calculating discounted payback? And you also need to give me the answer with reason, guys. Longer or shorter with reason, guys. Let's see what are the responses. Okay, I see again, Lokesh. I would appreciate with the reason also. Lokesh says it's longer. What about everyone else? What about everyone else? Reason with the answer. Everyone is saying me longer. Rohan says longer because we are saying in the terms of discounted value. So guys, when we are using a discounting number, let's say 30,000 divided by 1.1. Let's say I'm giving you a 27. I'm just using an approximate numbers, guys. So let's say we are using an approximate numbers in thousands. So we are saying that, okay, hey, discounting coming is, let's say, a 27,000. I'm just giving a rough number here. I'm not going for exactly 27273. I know the exact number is 27273. I'm just using 27,000. So my discounted cash flows, guys, do you agree my discounted cash flows will be lesser than the normal cash flows? And that means we will take longer to recover the same amount, guys. Logical? So again, my second year will give me a 24,000. Let's say it's a 25,000. Again, I'm just taking an example. Let's say these are discounted numbers. 25. Let's say the 20,000 of the third year is 15,000. Let's say this is 11,000. Next 10,000. Let's say this is 5,000, 4,000, and so on. I'm just taking an example in terms of a simple calculation, nothing else. So now, if I do a cumulative cash flows, 27, 52, 67, 78, 83, 87. Can you see, guys? It is actually going for 7 or 8 years. It's actually going to a 7 or 8 years, whereas my normal payback was a 4.5 years. So that means what I'm looking here is that the payback method is, when we are using an undiscounted number, is probably giving me a reason to smile about, but that is that a genuine smile? We are not considering the discounted factor. So the discounted payback period, that means the learning for us is the discounted payback will always be more than a normal payback period. We could go on to more number of years, but the problem here is that the profitability of the project is still not considered even in discounted payback, guys. Guys, make sense to everyone? I hope the payback period and discounted payback both are clear to everyone. Rohan says, what do we mean by discounting? Okay, Rohan, discounting is when I said that, okay, let's say today I deposit 10,000 in post office at the rate 6%. So Rohan, after 1 year, I will get 10,600. Do you agree? Discounting means I will take this 10,600 amount of 1 year later and multiply this by 1 plus 0.06 so that it will give me today's value. That's discounting. So in my example, 10,600 is a future value, 10,000 is a present value. I hope everyone okay now. And I'm sure the discounting, non-discounting, everything is like kind of discounting factor. How do we discount? I hope everyone is okay. Great. Let's go back then. So we're talking about, quickly cover that, as I said, that in uniform cash flows, a payback method is nothing but you can simply apply a formula, initial investment upon annual after-tax cash flow. So let's say a project is 10 lakhs, annual profit is 3 lakhs after depreciation of 20%. First, we need to calculate the after-tax cash flows, guys. So after-tax cash flows, which is given us a 3 lakhs of after depreciation profit, but before tax. So that means what I'm doing is I'm calculating after-tax profit of 150 and adding back the depreciation to get an annual after-tax cash flow. The word is cash flow, not profit here. We are using cash flows. So 10 lakhs divided by 3 lakh 50 is giving me a payback period of 2.86 here. So 2.86 years for a simple example here. The important point is that don't forget that we are using in denominator as after-tax cash flows, guys. Now, what happens if we have uneven cash flows? As I said, cumulative approach. We're going for a cumulative approach. So that could be resulting in a fraction of year also. So project costs 2 lakhs and yields the following cash flow. So these are the cash flows: 1 lakh, 80,000, 60,000, 40,000. So what we did was a cumulative, and I could see that, okay, hey, my 2 lakhs is somewhere recovering here. So 2 plus 20,000 upon 60,000. What I have yet to recover is 20 upon 60, so it gives me 2.33 years. A similar example, what we discussed earlier on the board. So uneven cash flows, you can't apply the formula. You just have to calculate the cumulative after-tax cash flows. But as I said, there are disadvantages. It is ignoring the time value of money, and it is ignoring the long-term project. It is ignoring the profitability after the payback period. So all these are disadvantages of this method. Another non-discounted or traditional technique is accounting rate of return, guys. Yes, Abhijit. So by discounting, we are bringing the future value to the present value. The process is called discounting. Okay. So now we are talking about accounting average rate of return. Accounting or average rate of return. Now this is also, by the way, a non-discounting technique. But there is one more problem to this, guys. We are using average annual net income. Where we say net income, we deviate from cash flows. So no cash flows. And we know that net income is susceptible to bias, susceptible to accruals, estimates. So that's a drawback anyways. No cash flows being taken, no time value of money. So numerator is average annual net income over the project life. Now, how do we measure investment here? Now, investment could be measured in multiple ways. Honestly speaking, guys, ARR can be part or a sub question in a bigger question, but yeah, the most important methods are more of a discounted methods for you guys. So investment could be measured, that is my denominator, in multiple ways. Either we take the initial investment, or we take the average investment over the life, or we calculate the ARR probably every year and we take the average. Now, there is an important point here. If I am taking additional working capital during the project, in addition to initial, then average investment cap formula, you need to understand this. Initial investment minus salvage value, you do it as a half because that's an average, probably an average investment. You add back the salvage value and additional working capital then. Because that's what you are looking at, an average investment, guys. Now, why I am doing a half of the initial investment minus salvage value? Because what we are looking at in this case is the salvage value will be towards the end of the project. Initial investment will be beginning. So on an average will be a net amount. And then we are adding back the salvage value because we are anyways not considering it. We are anyways not receiving it today. So we are adding the salvage value. We are adding the additional working capital as well. So guys, whenever there is an additional working capital, make sure that you understand, okay, average investment should be taken as a half of investment minus salvage value. Then you add back the salvage value. And of course, you need to add the working capital as well. Now, let's take an example. Cisco Limited is going to invest in a project of a sum of 3 lakhs, having a lifespan of 3 years here. And salvage value is 90,000. Profit before depreciation every year is 150. Profit before depreciation. So what is my depreciation here? Depreciation is the cost minus salvage value upon the life. So that means 3 lakhs minus 90,000 upon 3 is my depreciation 70,000. So net income is 1,50,000 minus depreciation 70 is 80,000, and then a profit of 30 as well, 30%. So 80,000 minus 30% is giving me a net income of 56. Now, my ARR is dependent on two factors. One is the average net annual net income, which is 56,000 for us. The second is investment. As I said, there could be multiple ways the investment could be measured. One is the initial investment, another is an average investment, or there could be an average of ARR. So that means if I'm using initial investment, my ARR is 56,000 upon 3 lakhs, 18.67%. If I say that, okay, hey, I want to average the investment over life, the same formula. Half of 3 lakhs minus the salvage value here, and then add back the salvage value will give me the average investment of 195. That's the average investment days. Another way to look at it, there's another way to look at this 195. I think some of you might not be 100% comfortable in the formula. Why we are adding back the salvage value? Let me explain this. You guys spent 3 lakhs here, and what you are getting is 90,000 here at the end. So if we average the beginning and the ending, probably it makes sense that, hey, average is 150 and there is also a 90,000 which we are anyways getting at the end. So probably we are looking at something like either we are looking at a 150 or a 45 separately, or we are looking at, okay, 3 lakhs minus 90,000 divided by 2 plus 90. So we are anyways getting a 195 as an average investment. Average investment is not 150 in this case. We are using it as a 195 because that's what my salvage value is. So if I'm taking that, my ARR becomes 28.72%. 56 is common in all the three methods. My 56,000, the numerator is common here. Numerator is common. So that means, you just need to know, okay, there are three different ways to calculate the investment. One is the initial investment. One could be the average investment over the life, right? Or probably we calculate another way that we calculate the ARR for 3 years here. Every year we are calculating an ARR and we are averaging out the ARR here. So what we do, we are saying that, okay, this is my opening investment after depreciation, 3 lakhs, 230, 160, because my depreciation is 70,000. So I have a 70,000 depreciation and that's why my annual ARR, which is taken as a 56 upon 300, 56 upon 230 and all, and I've taken just an average of the ARR and getting 26% an approximate here. I know ARR sounds very theoretical, very hypothetical, but at least we should know. Sometimes, okay, Charu says when to calculate initial or average. Charu, either the question would be clear or probably you could give your assumption which method you are using. Both the possibilities. But what I'm trying to say is that although it may sound theoretical, but you should know, sometimes even in practical life, management may ask, okay, hey, what is the ARR? Okay, so the capital budget project evaluation is a different thing. That is an evaluation as a capital budgeting part. But ARR is just based on the book profit. Okay, so of course, the advantage is that you have a ready data. You evaluate the management performance in real sense. And there is one drawback of payback period which is covered here, which is like it covers the entire life of the project. But the disadvantage again here is it ignores the time value. And because you are using net income, that could be basis different accounting policies and you are not considering a cash flow. That net income could be susceptible to bias. This is the disadvantage of, in this case of ARR. Guys, I hope you get a fair understanding of the payback method and the ARR though. Now we move on to the discounting techniques, but before we do that, I think it's 7:20 here. So let's do one thing. Let's take a quick 10 minutes break, and once we come back, we start our discussion on the discounting technique. So let's take a 10-minute break. Everyone, freshen yourselves, and get back to work after 10 minutes. Okay, welcome back, friends. I'm sure we're all back with a good breather, and let's dive in onto the discounting techniques of evaluating the capital budgeting projects here. Now, this is which is mainly major part of your questions have come in the previous examinations. Now, although you are supposed to be familiarized with all the methods, if I ask if someone asks you that, okay, what are the methods which are more frequently tested, those are the NPV and the IRRs, and the payback and the discounted payback comes on to the next one, right? So when we talk about the discounting techniques, the name itself says that, okay, it considers the time value of money by discounting the cash flows to their present value. So time value of money is considered by discounting the cash flows to their present value, and we use the discounting rate as WACC. I already explained that. Now, the net present value, the most common and commonly tested and the most interesting one is the net present value technique. As the name suggests, that we are looking at net and present value. So we're looking at, hey, present value of the cash inflows and the present value of the cash outflows. That's the difference. Or we can say initial investment. If there is no further outflow, you can use initial investment as well. But more or less, it's nothing but present value of cash inflow minus the present value of the cash outflows here. So that's one piece. And how do we calculate the discounted value? I just explained you. We take the cash flows of all the years, we discount it by 1 upon 1 plus R. And basically, we're getting the discounted value of the cash inflows over here. Now, we reduce the initial investment. So it will give us NPV. So what will be my decision criteria? Guys, who will tell me what will be my decision criteria, guys? What shall be my decision criteria for NPV? Okay, let's see who wants to respond to this one. So decision criteria, if I am calculating a present value of inflow minus outflow, there are various possibilities, right? Either my NPV will be a positive number, or NPV could be a negative number, or hypothetically, my NPV could also be a 0. Make sense, everyone? These are the three possibilities here. Now, very good response coming from many students here. Charu, Narayanan, Saurabh, everyone saying like positive NPV except the project. So if my NPV is positive, I will actually invest in the project. I think everyone is so positive in life, and that's the way to go about it. So we are saying that, hey, NPV is positive, guys. That's when we say that, okay, let's accept the project. Now we will talk this thing little later, that if my NPV is 0, that rate is called an internal rate of return. So we will talk about this when I will be explaining IRR, that a discounting rate at which my NPV is 0, that's called an internal rate of return, friends. Okay. So let's talk about brief steps here for calculating NPV. Determine the net cash inflow in each of the investment. So we had spent good enough time, guys. Net cash inflow in each year. We said that, okay, what are my yearly interim cash flows? I already talked about this. Select the desired rate of return or discounting rate, or a WACC. And find the discounting factor for each year based on the desired rate of return. And then we multiply this with the cash flows. So we multiply this to get the present value of the cash flows by multiplying the relevant discounting factor. The total amount of the present values of all the cash flows will give me my NPV, including the initial investment. Now I have a question, guys. What's the difference between a present value of a single amount and a present value of an annuity? Let's see who wants to answer this one. What's the difference between a present value of a single amount and the present value of an annuity? I guess we talk about a little bit on this on the cost of capital also. Any thoughts? Let us see what are your responses, guys. So what's the difference between the present value of an annuity and a single amount? I'm expecting some answers, just seeing what your responses on this one. The last few responses relate to the NPV more than zero. Those were absolutely okay. But I have a different question now. Okay, in the meantime, while I'm waiting for your responses, let me also explain here that if I'm looking at various cash flows, let's say when we use the word annuity, when I have an equal amount every year. So we could have, let's say, 10,000 cash flows every year, 10,000 cash inflow every year. So when we use this, so probably how we are discounting this. So let me make some space here for you guys. Let me talk about this. So if we are using same cash flows every year, let's say 10,000 cash flows each year. Yes, how I would be calculating the present value. So I would be doing a 10,000 into 1 upon 1 plus r plus 10,000 into 1 upon 1 plus r square plus 10,000 into 1 upon 1 plus r cube and so on. That's what I'm doing. What I'm doing is basically I am calculating the discounting or present value. So what we can do is we could take 10,000 outside and we can just add these factors. And this is nothing but a present value annuity factor. Because if I add these individual present value discounting factors, this is a present value and present value or annuity factor, which is like an addition of the present value factors for multiple years. Okay. Charu says single amount we need not consider, we need to consider the period, but in annuity we have to consider the period. Okay. Charu, in single amount also we will consider the period, I will tell you. Saurabh is saying annuity we have multiple cash flow. I think Saurabh, multiple and same. Hina, your answer is installment is same. Perfect answer, Hina. Same installment, same amount. We are using annuity when there is a same amount. Okay, perfect answer. Same with Pooja. So guys, make sense? So Charu, you said that in a single amount. So what is meant by single amount? Let's say in the same example, I had a additional working capital requirement here, 5,000. So for that, I will be using just a one particular year discounting factor for the third year. This is present value of rupee 1, single amount. The earlier one was present value of annuity factor. Although you will be getting the present value factor, so let me kind of explain you. Let's take an example of a discounting rate of 10% here. So year 1, 2, 3, 4, 5. So what is my present value factor, guys, for 10%? Let's quickly write this. So we are getting, I think the total generally comes a 3.791. So the first year is 0.909. The second year is a 0.826, 0.751, 0.683, and the fourth year is 0.621. I hope everyone with me on this. Now, the 3.791 is a present value annuity factor. So if I have same amount all the 5 years, I will be multiplying with say 3.791. So if I have a same amount, every year I can use this. But if I have different cash flows every year, then for discounting, I will be multiplying the respective year cash flows with all these present value factors. Guys, I hope this makes sense to all of you. And I hope the present value, discounting, all these GAN is absolutely perfect with everyone now. And rest is, of course, more and more practice. Okay, guys. So let's go back to our presentation then. So the rule is simple. If my NPV is 0, accept the project. If NPV is negative, reject it. So they've given an example here where we say that, okay, also an important point where we say that if there are multiple projects, then we might choose a combination of a highest NPVs. Let's say you have a budget where you can invest in more than one project. So you can select a combination which involves a highest NPV. Okay, so illustration here, compute the NPV for a project with a net investment of 120 and a cash flows for 3 years are 80, 70 and 20. Further, the company's cost of capital is 10%. Now they've given you, so more or less you will get these present value factors anyways. Yes, who will tell me the NPV for this project? I need a NPV of this project. Just waiting for your responses. Who will tell me the NPV for the project here? A quick check, guys. NPV. Okay, some of you are giving me an answer. Guys, I am asking NPV. Have you reduced the initial investment? I think I'm getting answers 145,560 and 25,560. So Abhijit, have you reduced 120 or probably you are giving me present value of inflows only? So we multiply these with respective cash flows and what you would be getting is 145,560 here. So 145,560 probably is the total of these. And when you reduce the 120, you get a 25,560. I hope this makes sense to everyone here. Make sense, guys? Everyone got getting 25,560? Sorry. So let me see the responses till now. Yeah, answers from Saurabh, Sandeep, Narayanan, Abhijit, Memun, everyone 25, 5, 60. Good. So everyone perfectly fine, that means. Okay, guys, amazing. So that means my NPV is more than 0, the project may be accepted. Now the advantage is, of course, the time value of money is considered here. Also, entire life of the project is considered. In payback, we did not consider the entire life. And it is in line with my financial objective of wealth maximization. Because we are anyways considering the WACC, mind you. Some of you, I think Saurabh or someone else, asked me that, okay, why we are using WACC? Because that becomes in line with my return with my stakeholders' expectations. Disadvantage, of course, probably this is just an absolute measure, and you may not consider the risk involved directly or indirectly. You may have other means to look at, okay, higher discount rate. So practically, if you honestly ask me, even in NPV, we can consider, let's say there are two projects. One is a more risky because it involves larger investment. So probably you can use a higher discount rate, marginally higher rate for a more risky project. Or otherwise, of course, the entire decision depends on the estimation of the cash flows and discount rate. So if your estimates are gone, then you are gone. So estimates have to be good. Okay, so let's do a practice question, guys, here. Let's talk about some MTR masalas. And let's see how much good we are on this one. Let's read the facts. So MTR Limited is considering buying a new machine which would have useful economic life of 5 years at a cost of 25 lakhs. And a scrap value here of 3 lakhs, with 80% of the cost being payable at the start of the project and 20% at the end of the year. The new machine would produce 75,000 units per annum with an estimated selling price of 300 per unit. Direct cost is 285. Annual fixed cost, including depreciation, is straight line. It would be 840. In the first year and the second year, special sales promotion expenditure would be incurred for 1 lakhs and 1,50,000, and they're asking us to calculate the NPV. Now, before we solve this, Rohan says, how do we calculate the estimated future cash flows? Rohan, for example, you end up into getting a projected sales. So you might have to evaluate your selling price into the projected number of units, your projected direct cost, and that's where like I think the perfect answer to Rohan's question. So Rohan, if you see this example, so probably what we are looking at is, in this case, is a projection here, right? Would be, the machine would produce their estimated selling price, direct cost would be. So these are the projections, right? So Rohan, you will have your sales forecast team, your product engineering team, which will give you the cost inputs. So all based on the forecast. And that's what I say. If your estimates are gone, you are gone. Saurabh, why do you say including the finance charges? Because finance charge will not be included now. Finance charge will not be included because you are anyways discounting. Finance charge is taken care by discounting. Okay, so guys, let's talk about this one. Now, one more thing I wanted to say here is that I'm sure all of you would have got your, all these notes before the lecture. So the file you would have got is of course with all the concepts and the questions. Don't worry. After Thursday's lecture, I will upload another file with all the solutions. So don't worry about that. Okay. For the questions for which you might need solutions, the file will be uploaded after Thursday's lecture, so that you guys can work around till that time as your own practice and as a homework. Okay, so in this case, we are looking at 75,000 units per annum, right? So when we are looking at a 75,000 per unit, guys, what do you think? Probably in terms of 75,000 units, my selling price is 300 and my direct cost is 285. So what I'm getting in return, guys, then? So cash inflow would be a 300 minus 285, 15 into 75,000, guys. So annual cash inflows is something like 1125. What are your thoughts? Into 15, 1125, or do we need to make some other adjustment as well? What do you think? Let's look at that. There is one more information given to us. The annual fixed cost, including the depreciation calculated on a straight line basis, would be 8,40,000. So there are cash fixed costs as well. My total fixed cost is 840. What is my depreciation here? Guys, can you give me the depreciation in this case? There is a 5 years life. 5 years life, new machine, scrap value of 3 lakhs with again 80% of the cost being payable at the start and 20% at the end of the first year. So what's the depreciation here? What will be the depreciation? 25 minus 3, 22 divided by 5. 4,40,000 is depreciation. So that means my cash fixed cost is 4 lakh. And hence, annual cash inflows is actually 725. Everyone with me on this? 725, guys? And by the way, the question itself indicated the tax ignorance for this question. If tax was given to us, then we would have taken the depreciation tax shield also. But we don't need to consider the depreciation tax shield. So 725. Now, that means my initial outflow is a 20 lakhs. After 1 year, there is a 5 lakhs outflow. And then they're also given us some outflow. So let's calculate. I hope everyone with me till this point of the time. We have 7,25,000 annual cash inflows. Let's try to calculate the present value now. Look at this. My initial cash outflow is 20 lakhs, guys. And 1 year later, I had to make a balance payment of 5 lakhs. Cash inflow every year is 725. We just calculated that. And there was a special sales promotion expense only at the end of the first and the second year of 1 lakh and 1,50,000. That's what given in the question. First and second year, guys. 1 lakh and 1,50,000. So that means my total cash flows. Mind you, there is also a terminal cash flow. At the end, there is a sale value of the machinery given to us 3 lakhs. So now I add up my total cash flows as 20 lakhs, 1,25,000, 575, and so on. Interesting question from Saurabh. Saurabh says fixed cost is not a sunk cost. Saurabh, the existing fixed cost or any irrelevant cost could be a sunk cost. Or let's say the purchase price of the existing machinery. Let's say my existing machinery was 10 years old. That was a sunk cost. In this case, you are only talking about a machine. You're not talking about anything existing. So for producing this 75,000, you are incurring this annual fixed cost of 8,40,000. So we consider the cash portion. Na? This will be relevant. Saurabh, I hope it makes sense. This is for this machine. Not every fixed cost may be a sunk cost. We have to check the details. And then we have a present value factors at 10% given to us. We can multiply them and we can see that, hey, we are getting a positive NPV and hence the project should be accepted here. Guys, I just want to give you guys a 1 minute to understand and let me know if you have any question here. I hope everyone got this NPV, guys. How to get 5 lakhs? Menon is asking me how we got 5 lakhs. Menon, because 25 lakhs was the cost. In the question, if you read the second line, in the second line, they have said that 80% of the cost is payable at the start of the project, 20% at the end of the first year. So 25 lakh may say 20 lakh is incurred in the first year, in the beginning, and 5 lakh is spent after end of the first year. So that means 20 plus 5. That was our initial investment, 25. Does this make sense to everyone now? Guys, I hope everyone with me on this one. And don't worry, guys, while we'll be solving some questions in the class, you guys will have a lot of questions at the homework as a practice questions. Once we end the session on Thursday, I will give you some questions to practice within this presentation as well. Don't worry. And you guys will get the solutions after the lecture. Okay, great. So I'm assuming that I think some of you have clarified your doubts, but I think everyone else is clear. Guys, one more thing. I think we need to also understand that if you're not asking me questions, there are two possibilities. One possibility that it's all clear, and the other possibility is all clear. I don't want the second one all clear, it goes over the head. That all clear I don't want. You ask your doubts wherever you feel, may I ask you guys, why don't students ask doubts, guys? Some students don't ask doubts because they feel shy, right? They feel shy. And why they feel shy? Itna bhi nahi aata isko, that he doesn't know even this much. That's why students don't ask doubt, right? You feel shy, you feel scared that, what will others think of me? Yes, have confidence of that level in your life. When I was a student at your age, I used to think that if I don't know this, how the hell anyone else will know this? Also, out of my 14 years of teaching experience, I can tell you, friends, that please don't hesitate to ask your doubts. The reason is, when you ask a doubt, trust me, there are hundreds, thousands of other students who are thanking you from the core of their heart. Thank God he asked this. Even I was hesitating. You should have that kind of a confidence level that, ask anything if you want. I hope this makes sense to everyone. Everyone doing great now. See this? Suddenly, Khushi said, please explain this again. Khushi, which point you want to understand? Khushi, which part of the solution you did not understand? Can you please specific? Vrinda, I saw a question. 725,000. How did we get 725? Vrinda, you asked that question, right? So let me explain 725 once again. Guys, 75,000 units. Everyone with me? Selling price is 300. Direct cost is 285. So what is my contribution, guys? 75,000 into 15. So my contribution is 11,25,000. Now fixed cost is given to us as 840. But guys, the problem is in 840 that there's a depreciation also, I guess, because that says that includes depreciation. Now the cost of the machine is 25 lakhs, 3 lakh scrap value, and 5 years. That means my depreciation is 4 lakh 40. Charu, that's absolutely fine. We all had different names, right? So my fixed cost is 8 lakh 40 minus 4 lakh 40. So the cash fixed cost is only 400,000, 4 lakhs. So that means my cash profits, because tax is not relevant here, is 725. Vrinda, I hope that this is clear now. How did we get at 7,25,000? Vrinda, I hope that is okay. Rakesh, 5 lakhs was the payment to be made in the first year. Na? These are years. 5 lakh is the payment to be made after the end of the first year. That's why 5 lakh is here. Rakesh, that's the cost of the machinery. 20 lakhs you are paying initially, 5 lakhs after 1 year. Okay, one question from Prema. Prema, how did we get NPV? We multiplied all these with the present value factors. So there are cash flows. We multiplied with the present value factors. We calculated the present value of cash flow. So minus 20 lakhs plus this, plus this. So when we add all these up, we get an NPV. We added all the present value of the cash flows, whether inflow or outflow. That's giving me NPV. That's it. Or you could separate out present value of cash inflows. You can add these separately, and you can add present value of cash outflows separately, and the difference would be NPV. So I hope this is clear to everyone now. I guess I think you should then practice more, again this question and try that, probably if you can solve this one. Okay. Okay, guys, are you guys ready for some brain teasers? let's talk about some brain teasers here, guys. Now, question number 1, guys, A, B, C, or D. Let's talk about few brain teasers. I will come back to that doubt. Someone was asking me why we added the salvage value at the end, because salvage value is generally at the end, guys. Scrap value or salvage value is normally at the end of the project. They will not, even if they don't specify, we will take at the last year. So guys, what is the answer to question number 1? Sandeep, I think I answered your question also. The terminal cash flow is the cash flows in the last year. So that includes the regular inflow, salvage, working capital, could include anything. Terminal cash flow, the last year's cash flows. Okay, guys, what are the answers? Everyone, please. I got just one answer from Charu here. So I think now everyone is giving me an answer. Payback period. Yes, the point is and which is the technique which does not require the discounting. So they're just asking you what is the non-discounting technique. And we know that the answer is payback. So good round of applause for those of you who got it correct. Absolutely good, guys. What about question number 2 then? Sushil, question number 1 will be D. Also, Vrinda, it would be D, not C. Payback. We have not even discussed modified internal rate, but that includes discounting. What the question's call was, which doesn't involve discounting because doesn't require computation of cost of capital. That means they're asking you which method is a non-discounting technique method. So answer is D, guys. What about second? Second says, in case company considers discounting factor higher than the cost of capital. Now, the present value of cash flows, will that be higher or lower? Or will it be same? Second question is a very interesting question, guys. Okay, someone said all options are not visible because probably of the screen settings or whatever. Guys, option number A is less than the cost of capital cash flows. Option number B, more than the cost of capital cash flows. Option number C, equal, and D is none of the above. Someone said D, none of the above. How can be none of the above? Because logically speaking, those of you are giving me an answer B or a higher. Guys, there is an amount. I multiply that by 1 plus R. Let's say rate is 10%. My WACC, cost of capital is 10%. But for discounting, I take 12%, guys. So will this amount, will this present value increase or decrease? I think it will decrease, guys. If you are discounting with a larger rate, your value will be less. So guys, answer has to be A here. So we are looking at less than the computed on the basis of cost of capital. Answer has to be A. Those of you said higher, it will be actually a lower number, guys. I hope is it clear to everyone, because if I'm discounting with a higher number, definitely I'm looking at a lower value, lower result. I hope both the questions are clear to everyone now. But anyways, that was a good attempt. I think some of you anyways got both the questions right, I guess. That was a good job, guys. Okay. So let's move to the next discounting technique quickly. This talks profitability index or a desirability factor or a present value index, various names. What do they call, right? Naam anek, darshan ek. So we call it by different names, but it means the same. Profitability index, desirability factor, present value index. Guys, what do we do in the net present value? Net present value says present value of cash inflows minus present value of cash outflows. In the profitability index, we just replace this minus by divide. We're saying that, okay, present value of cash inflows will be divided by present value of cash outflows. Now, if that is the case, what should be my deciding factor, guys? NPV में, you guys said positive है तो accept. What should be my deciding factor for a profitability index then? If the profitability index should be more than 1 or less than 1? More than 1, right? Because I want a positive NPV. Positive NPV means if my profitability index is more than 1, I'm accepting it. If profitability is less than 1, reject it. And if I'm comparing multiple projects, as we talked in NPV, select the projects with the maximum NPV. Here also, a highest profitability index will be selected. Good job, Rohan. Lokesh, I just saw your answers. Absolutely correct. Charu, you as well. Absolutely perfect. Charu, Sandeep, Narayanan, all are good answers, guys. Wonderful. So we talk about an example here, two projects with discounted cash outflow of 100,000, 1 lakh and 1 lakh 20,000. Discounted cash flows given as a 1 lakh 50 and 1 lakh 90. So my profitability index comes out to be 150 divided by 100, that's 1.5. And for the second one, it's 1.58. And that means my second project should be preferred over the first one, guys. Second project is definitely preferred. And what are the advantages of this? Yes, time value is considered. And probably it might be better than NPV because it is a relative measure than an absolute measure. Because my NPV was an absolute measure, guys. It's a relative measure. The only problem here is that when I have a limited capital, it might not be helpful. Why? Because let me give you an example of this one. Let's say there are two projects, project A and project B. Both have different inflows and outflows. Let's say my investment in project A is 10,000 and investment in project B is 1 lakh. And let's say a present value of inflows. Project A is a 14,000 and for project B, it is 1,38,000. So my NPV is 4,000 and a 38,000. But when I calculate my profitability index in this case, this gives me a 1.4 and this gives me 1.38. Profitability index says that project A is a better option. But you understand that project B actually is giving me a good input, 38,000 positive NPV. Got a question about what is a relative measure, Lokesh? That's what I'm explaining right now. A relative measure is in terms of, non-absolute amounts. NPV was an absolute amount. So what I'm trying to say is that you can see the comparison. One method can be good in one context, another method can be good in another context. Now, in this comparison, project B looks good, but if you select based on profitability index, you might reject project B. So obviously the decision will boil down how much funds do you have, right? Because in project B, you have 10 times more the investment. But I hope this makes sense to everyone. Lokesh, that's absolutely fine. Any doubts, please ask. That's absolutely fine. I hope you got it. You guys can ask any question, guys. More than welcome. But I hope everyone clear on this, that the difference between profitability index and NPV here. Yes, Rohan, that's what I said. The decision will also incorporate whether I have that many funds or not, and also the risk involved. I absolutely agree. I'm not denying that fact. Absolutely agreed with that. Okay, so let's now talk about another question here, which is based on a net present value and profitability index. Let's quickly dive into this. So Navjeetni Hospital is considering to purchase a machine for medical projectional radiography, which is priced at 2 lakhs. Projected life of the machine is 8 years and has an expected salvage value of 18,000 at the end of 8th year. Annual operating cost of machine is 22,500. It is expected to generate a revenue of 1,20,000 per year. And the hospital presently is outsourcing the radiography work to the neighbor test center and is earning a commission income of 36,000 per annum, net of taxes. Wow. So probably, what do we call this 36,000, guys? Can you give me a good fancy word for this 36,000? Charu, depending on, if you had 1 lakh, I would have gone for project B. So question here is, what do we call this 36,000 as, guys? What do we call 36,000 as? Okay, wow. Rohan, amazing. Rohan says opportunity cost. Jamil said replacement. I would agree with Rohan. It's an opportunity cost, guys. Because if you want to bring this in-house, you will lose this commission. Because presently you are earning in commission, but now you are considering in-house radiography. 36,000 is an opportunity cost, guys. Guys, I hope this makes sense to everyone. So that means you're talking about a 120,000 of a revenue and an annual operating cost of a 22,500. Can anyone tell me what will be my annual cash flows, guys? Can anyone tell me what will be my annual cash flows? What will be my annual cash flows here? Because we have to also calculate depreciation here. My depreciation is 1,82,000 divided by 8. That's a 22,750. So 1,20,000 minus 22,500 minus 22,750, you're getting a 74,750 profit before tax. And minus the tax. So you get a tax of 30% here. So I'm getting a 52,325. Make sense to everyone? $52,325, guys. Everyone with me on this? And then we add back depreciation. We add back depreciation. That was 22,750. So 70,575. Yes, can you please double check the calculation here? 75,075, and that means then there is an opportunity cost of 36,000. Because that is something you will be losing. That's an outflow. That is net of taxes already. So 39,075 per annum. That is what you are going to make from this machine. 39,075, guys. I want a quick understanding. Did you understood how we arrived at 39,075 here? We're talking about a sales minus operating cost, minus depreciation, minus tax, and the depreciation is added back. And then the commission income, which is nothing but an opportunity cost for us. So 39,750 is the cash flow for 7 years. 7 years, 39,755. A question from Tulsi about how did I calculate the tax amount? Tax amount is 74,750 net income into 30%, Tulsi. 74,750 into 30%. 30% is given to us in the question. Everyone with me on this? 39,075, please. In the last year though, in the 8th year, there is also a salvage value of the machine, 18,000. So last year cash flow is 57. Last year cash flow is 57,075. So the first 7 years, because it is a common amount, we can use a present value annuity factor. That is 4.867. And the 8th year, we are using the 8th year single amount, single annuity factor. And we're getting a positive NPV of 16,832. Not only that, even the profitability index is of course more than 1. So that means Navjeevani Hospital can actually find a new Jeevan in this project. Because the positive NPV and we are looking at more than 1 profitability index, guys. Yeah, Jamil, Charu, Pooja, all are perfect answers. Perfect answers. I guess everyone with me and everyone is kind of rocking right now, understanding that NPV and profitability index. It's just that you need to be very careful while you are reading the facts. So as they say, practice makes perfect, right? And there used to be a saying that, practice makes men perfect. Then I requested those lawmakers that eliminate the word men out of that. Whether it is men and women, practice makes everyone perfect. More and more practice you will do, I'm sure you will improve on. Okay, let's also talk about now quickly something called internal rate of return, guys, IRR. I told you this rate is the rate at which the NPV is 0. So IRR for any proposal is the discount rate at which the present value of the expected inflows equal the present value of cash outflows. That means NPV is 0. We compare the IRR with the organization's desired rate of return, guys. We compare the IRR with the organization's desired rate of return. Now, what should be my decision criteria? What is the desired rate of return, friends? What is the organization's desired rate of return? WACC? Hurdle rate? Can you tell me what will be the decision criteria? NPV may very simple, sir. Positive NPV, we go ahead. Profitability index, sir, more than 1, go ahead. What about IRR? Okay, we compare IRR with the hurdle rate, then what? When to accept, when to reject. Waiting for your responses, guys. What will be my decision criteria here? What do you think? You want your life to be a little easier? Should I ask the question then? let me make your life a little simpler. What if, okay, I got some responses now finally. I got first response from Rohan. Rohan says, if IRR is less than, Rohan, very interesting. Rohan, we all love you for that. I want an example here. Rohan says, and I think many other students, it's not about only Rohan. I can see there are 3 or 4 other students also giving me the same answer, that IRR is less than the hurdle rate, you accept the project. Let's talk about this. Let's take an example. IRR is 7%. And I say that WACC is 9%. So as per Rohan and other team members here, there are almost like 5 to 6 students who are telling me that accept the project. Guys, IRR is the rate, then the NPV is 0. Guys, you guys need to tell me, agar NPV at 7% 0 hai, then what will be the NPV at 9%? Will it be positive or negative? Will it be positive or negative, guys? And if you get that, you get an idea. You get the answer to my question then. Pooja, you will get an idea in 2 minutes. There are other students, Lokesh, Narayanan, who are saying that, okay, sir, IRR should be more than hurdle rate. But right now I am asking a different question altogether. If IRR is 7%, my WACC is 9%, my NPV at 7% is 0, what will be my NPV at 9%, guys? Positive or negative? Everyone is like negative. Absolutely negative, guys. If my 7% is giving me a 0 NPV, my 9% will give me a negative NPV because I am discounting with a higher rate. Project should be rejected, Khushi. Project will be rejected. That means if my IRR is more than the hurdle rate or the WACC, then I should accept the project. Does this make sense, guys, to everyone? Everyone with me on this? Charu, Lokesh, that had, I think some of you said positive. I think that had to be negative, right? You are discounting with a higher number. Guys, can I get a confirmation from you all on the chat box? Are you understanding now? Can you please confirm? Another example here. My IRR is 10%. WACC is, let's say, 6%. Now, that means IRR means NPV is 0 at 10%. That means NPV at 6% will be positive, guys. And hence accept the project. Can I get a positive confirmation from all of you? Please, if you guys got this. Just tell me yes or no. If you still have any doubts, let me know. Okay, Pooja, Narayanan, Sandeep, thanks for confirmation. And I'm just assuming that everyone else also understood it. Okay, so how do we calculate the IRR? Now, pretty simple, guys. If there are uniform cash flows, we know at IRR, present value of cash inflow is present value of cash outflow or initial investment. And what is the present value of cash inflow, guys, in case of uniform cash flows? We multiply the annuity factor, present value annuity factor, with the annual cash flow to get the present value cash outflow. That means we will see the annuity factor in the annuity table, the present value annuity factor against the life of the project. Let's say against n years. That means what I'm trying to say here is IRR shall be the rate that corresponds to the annuity factor that is in that table along with the row for the number of years. Let's say just taking an example, guys. Let us say my present value of cash outflow or my initial investment is 3,22,235. Just an example here. My investment is 3,22,235. And let's say my annual cash inflows is 85,000. 5 years का project है. 5 years. That means my present value annuity factor here will be 322,235 divided by 85,000. What's the answer, guys? 3,22,235 divided by 85,000. I am getting a 3.791. Now, if you look at the annuity table, guys, if you look at the annuity table, then in terms of annuity table, you will see that where this 5 years factor is coming into account. How we take into account this 5 years factor over there? 3.791. Let's talk about that for a moment. If I kind of refer you guys quickly to an annuity table, probably that will make your life simpler. Let's see what are my annuity tables looking like. So my present value annuity factor table is this on your screen right now. So we are talking about 5 years. And I think what we got was 3.791. Next, can you locate 3.791 for me? Against 5 years, can we see 3.791 over here? That means my IRR is 10%. Sandeep, so IRR becomes 10%, right? Yes, Charu, we will do that also. We'll come to that. Hey, sorry, but I'm just taking 5 more minutes. We'll just wrap up in 5-7 minutes, please. So coming back, in my example, this 3.791 is falling against 10%. That means my IRR. Now, as we did in the payback period, life is much more easy when we are having a uniform cash flows. Life is much more easy when we're talking about uniform cash flows, guys. What if you don't have a uniform cash flows? Because in the uniform cash flows, I am just doing, okay, present value annuity factor is initial investment upon the annual cash flows. That's it. And look at the annuity factor. So there are two things. What if there are no uniform cash flows? Also, what if that I don't get an exact number in the annuity table? What do you do then? You're stuck, right? If I'm not having a uniform cash flows or it doesn't match, then we have to use a formula for IRR, which is at the bottom on my screen. What you have to do is, then you have to calculate NPV of that project using two rates. Mind you, you have to use two rates in such a way that one gives you positive NPV and other gives you negative NPV. One gives you positive NPV and other gives you negative NPV. That's how you should be using two rates. But my question is, for you guys, let's say, okay, my annuity factor is not locatable in the annuity table. And let's say I take as an ad hoc rate, take any rate. take any rate. Let's say I take 8% and I get a positive NPV. I told you to calculate two NPVs, one with positive and one with negative. Guys, do you agree with me? That means I might have to take a next rate as a more than 8%. Let's say the next one is 12%. 12% pay NPV might be negative. Or for that matter, let's say, I'm taking another example here. Let's say I took 10% and my NPV was negative. In that case, for the positive NPV, you might have to take a 6% NPV. So the idea is you are taking two ad hoc rates. Assume any random rate, 10%, 12%, 6%. And if the number is positive, if NPV is positive, then calculate NPV at a higher rate or vice versa. Guys, I hope that makes sense to everyone. The formula makes sense. So we are talking about NPV using a formula here, which is a lower rate plus NPV at lower rate upon NPV at lower rate minus NPV at higher rate into the difference. That is what will be giving me the IRR. This formula you have to learn, you have to practice, and that will be your homework for the day. This formula have to be learned, have to be practiced, guys. And absolutely correct, Pooja. Pooja remembers, I already explained this in the cost of capital also. I told you we will be doing this again at IRR. I hope this is clear to everyone, guys. Now, my point is, be careful. Be careful in the denominator, guys. Guys, NPV at a higher rate will be negative or positive? Guys, NPV at a higher rate will be negative or positive? Can you guys please tell me? Last question for you guys. NPV at a higher rate will be negative, right? Lower rate NPV will be positive and higher rate will be a negative one. So if I'm seeing NPV at a higher rate, if that is a negative number, this will be negative. And if you look at the formula, in the denominator, you have a minus sign. That means the denominator may, so minus sign hai, that will be minus minus positive. It will turn that minus into a positive because there is already a minus sign. Great. Amazing. Charu, Tanu, Pooja, Vandana, all responses perfect. So denominator mein there is a negative sign. That means denominator will be actually totaling the two NPVs because NPV at higher rate is already a minus. So it's like a 100 minus, let's say 20. It will give you a 120. As an example. So guys, let's do one thing. It's already 8:40 here. So probably what we can do here is let's wrap up the session. And I want you guys to do a little bit of a homework here. So there is an illustration, the file which I had already shared with you, which talks about of this illustration. I want you guys to, just have a good check on the illustration, which is nothing but with respect to your IRR. I'm sure you guys will be able to do that. And one more, example I wanted to give you as a homework, and you guys can ask me as a doubt in the next class. Just give me a second. Yeah, so one is the Zebra Limited illustration is a homework for you guys. And then which I've already explained you, the IRR using the uneven cash flows. We are using the same formula as I've already told you, same formula for uneven cash flows. Take any random rate to start with, 10%, 15%, take your favorite number. But you need two NPVs. One is a higher rate and one is a lower rate. So that means you are talking about a positive and a negative NPVs, and you basically take that same ruling that, okay, hey, if my IRR is more than WACC, accept the project, otherwise reject the project. So I want you guys to read the illustration of Zebra Limited and also try this question with respect to, which is with respect to IRR over here. So there are two homeworks, guys, for you guys, Zebra Limited and this illustration of installing a machinery here on the screen right now. I want you guys to solve these two for me. Come prepared. If you have any questions, let me know. Otherwise, I will quickly walk through these and probably proceed with the other aspects of capital budgeting. And there will be a lot of practice in the next session, guys. Some of the concepts which are still remaining here, we'll be talking about, this modified internal rate of return in the next class. Then we will be also talking about NPV versus IRR conflicts. And then we will be talking about some, 2 or 3 practice questions in the class. And I will be giving you a lot of practice questions as a homework. Once we end Thursday session, there's a lot of questions, around 3 or 4 questions I have included for you guys, which you guys can practice. And you guys will be provided with the solution as well. So please do this homework. I am just relying on you guys. You need to do this homework. Do the Zebra Limited illustration and this illustration, which is a installation of machinery where you need to calculate a IRR, guys. So thanks a lot. All of you, it was amazing as always. Amazing evening with you all. You guys were superb in response, super enthusiasm, and I'm sure that your hard work will pay off. Continue the hard work, guys, and just be safe. I'm sure, probably the restrictions and everything is kind of eased out across all the states. But I request you to kind of take care of yourselves, study hard, and keep safe and healthy. See you all on a day later. That's on Thursday evening, guys. Take care. Good night.